SBRN is a network of professionals who provide services to the business community. We're a program of the Florida Small Business Development Center here at UNF. My name is Nancy Boyle. I'm the director of the SBRN. And just to let you know, our members are accountants, they're business attorneys, commercial lenders, commercial insurance agents, business consultants, a variety of government and nonprofit organizations, and some select corporations who are vetted for their experience in working with small businesses. You can find out more about SBRN at our website, which is www.sbrn.org. And before we begin today's presentation, let's just do a couple of quick housekeeping items. If you have questions, please type them in the questions area of the control panel, and we'll address the questions at the end of Erin's presentation. We are recording the presentation, so you'll be able to review it. Once it's finished, you'll receive a link so you can review it. You'll also receive a short evaluation of today's program. So we really appreciate it if you would fill it out and give us your feedback. Before we get started, if y'all could take a minute and take our little poll here. We want to find out if you're just in the process of getting started in your business, or if you have an established business and you're looking to grow your business. So go ahead and take the poll.
And Nancy, it looks like 100% of folks have answered that, so I'm going to go ahead and close it.
Okay.
And share the results if everybody can see that it's 100% of attendees so far are starting their business. So.
Okay, good to know. That'll help Erin in engaging her presentation to you guys. So let's go ahead and begin our presentation. Our speaker today is Erin Scott. Erin is Vice President at Ameris Bank. She's a commercial lender. She's a graduate of the University of North Florida, where she earned her bachelor's degree in communication with a focus on public relations. And after a brief stint in marketing, she began her career in banking at Oceanside Bank. So for the last 14 years, she has been helping small businesses grow their business by providing financing. Currently, she serves as the treasurer and secretary for Providence JDL Football, which is a youth football league. She's on the Women's Advisory Board for Gabriel House of Care. She's on the board and as a mentor for the Empowered Kitchen, which is a local nonprofit organization that helps women navigate entrepreneurship in the Culinary Institute. She is also the chair of the membership committee for the Small Business Resource Network. And Erin's passion is helping people. She brings this to her job every day by acting as a resource for her clients and for those around you. She has two boys, Hunter, 9, and Parker, 4, who are into sports and the beach and going glamping in their travel trailer. So that gives you a nice introduction to our speaker today, Erin Scott with Ameris Bank. Erin, take it away.
Thank you.
Elliot, you need to take the poll slide down.
Thank you for having me. I apparently sent Nancy an old bio. My kids are now 5 and 10. But nevertheless, thank you guys for having me. So like as Nancy said, I've been with the bank going on December will be 15 years. And I, my passion is helping small business owners. And when Nancy approached me about doing this webinar, I wanted to kind of touch on things that I think a lot of small business owners just don't know. And just because you don't know, you've never done it. And there's a lot of tricks to being a small business owner. I've always tell my customers that I could never be a small business owner. I don't have the guts to do it. So I commend all of you for what you guys do.
Erin, oops, sorry to interrupt. We're having a screen sharing issue. Sorry to interrupt, folks. Technical difficulties today. Can you reshare your screen? It looks like the survey got stuck.
You need me to reshare?
So I can't hear your PowerPoint.
See it now?
Stand by, folks. Are you seeing your PowerPoint on your screen?
I am seeing my PowerPoint. Are you not seeing my PowerPoint?
No, it looks like it's
Okay, let
stuck.
me close it. Let's do this.
Survey. Survey is closed, but it's like it's stuck on the screen.
Can you see it now?
Not yet.
No. I'm gonna change presenter. I apologize, folks. We're having some trouble this morning. I'm gonna change presenter real quick and then switch back to you, Aaron.
Okay.
There we go. Okay, we're in business. Go
Got
ahead.
it? All right. So because of all the technical difficulties, because it's Friday morning and I think everyone's just done for the week, you get a picture of me because I can't get my webcam to work. So I, as Nancy said, is a business banker here at Ameris Bank. Janice Bounds was going to join us and was unable today, and she's our SBA lender here at Ameris Bank. And she is a great resource as well and very involved with SBDC as well. So since it looks like the poll, it looks like most of you guys are starting your business. I don't want to, dumb this down, but I want to make sure you guys understand like what's important. You probably already have some of you may have your companies established and maybe some of you don't yet. So some of these slides I'm going to kind of fly through and just feel free to put in the chat and Allie or Nancy will, answer those questions or let me know when those questions come in and I can answer them as we go. So feel free to interrupt me at any time. So the basics of starting a business, right? You have to determine what is the structure for you. And I always say that the three most important parts about starting a business is you've got to have a good attorney, a good CPA, and a good banker. I find those like the three most important things when you are starting a business, because an attorney is going to get you set up properly, make sure you're, everything is good with the state, good, functionally, and then your CPA is going to help you with your making sure you stay out of trouble with the IRS, of course, but also to help you strategize how to conduct your business. And then a good banker is going to grow with you. So there's a couple options, and there's more than this. So just make sure if you're not established yet, look through and talk to an attorney about which entity is a good fit for you. Because this webinar is about how to obtain a business loan, I wanted to make sure you also knew about the articles of incorporation and the company bylaws or operating agreement. Those are two things that are very important, and I can't tell you how many times I go to do a loan and I'm at close, going through the closing process, and I request an operating agreement or the bylaws. So the difference between the two is just one's if you're a corporation and one's if you're an LLC. That's it. They're basically how your company operates. And they don't have them. A lot of small business owners they're sole proprietors, they're or an LLC, and it's one person that owns 100% of the company. It's still very important to have. So I would encourage you guys, if you don't have those, to get those organized. You would have to have articles, because I think in order to register with Sunbiz with the state, you have to have those. It's the bylaws and the operating agreement that people don't realize they need. I skipped right over this, but like, how many owners are there in your company? Some people are strategic. It could be a husband and wife, and he's 49% and she's 51, because if she's 51% owner, it's considered a minority owned business. So there are strategies around that as well. But you also have to remember that whoever owns the business is responsible for the business, including the financials. Accounting, right? So some people, you don't want to, you're good at what you do, right? So I'll just say briefly on accounting. You have to think of your accounting not just for short term, do I have enough money in the bank, but long-term goals. So what does your financial future look like? Are you going to need a loan in the future, or are you never going to need a loan? I would say, as the treasurer of my kids' football league, and I hate the accounting part of this. It's terrible. Everyone assumes because I'm a banker, I'm a good treasurer, but I don't want to do that. So there are software out there for you. There's QuickBooks, Quicken, Sage, Xero, And just because it's free, it's not always worth it. You have to get something that works for you and does a good job. I would say interview your accountants and your bookkeepers. If you just need a bookkeeper because you're a small business and you just need somebody to run your monthly numbers for you, great. You may not need a full accounting service, as a full CPA, but interview them and consider what you need. You're an expert in your industry. If that's not accounting, consider hiring somebody who is, right? I don't pretend to be an accountant, and I would never pretend to be an accountant. And so you need to make sure that you have somebody who's watching your books for you. It's really very important, especially when you go to get a loan, because if you send me as a business banker, if you want a loan and you send me your, and trust me, through PPP, I saw a lot of this where people didn't have this. They weren't as sophisticated to, they thought, oh, I'm just a small business. I don't need all of that. Like, everything's fine. You need it. I can't accept, if you go to get a loan one day, I cannot accept an Excel worksheet of, what you've put together. So make sure, whether you're doing it yourself through QuickBooks or have it, hire somebody. Consider your future goals. I recommend that you speak to your CPA or bookkeeper accountant at least once a quarter. I had lunch with a CPA this week, and we were just actually discussing this, and she says the same. She said she wished her clients would reach out to her more often, but what happens is it's the end of the year, and people, for tax purposes are sending her stuff. Well, they didn't have conversations, so the accountant has no clue. And there's a lot of things that you can write off. There's tax advantages, but as a small business owner, when you go to get a loan, but the prior year you wrote off a ton of stuff because it was a tax advantage for you, it doesn't work. It's not a win-win for you. You can either write off a lot of stuff and get the tax advantage, or you can show you made income and get a loan. So you have to, talk to your accountant, let them know what your goals are so that they can help you be strategic in your financials. Financial reports. So this is kind of like, so all of these come through. If you use a software like QuickBooks, you can generate these through those software. But a balance sheet, it's basic. It's your assets and your liabilities, and then it's your net worth. So your assets minus your liabilities, that's what your company's worth. That's super basic, and it's very more involved than that. But in short, that's what your balance sheet looks like. So you want to make sure your balance sheet has everything on there. Your profit and loss. So your balance sheet includes your cash in the bank. It includes your accounts, sometimes includes your accounts receivables. It includes your equipment. So make sure that is always current. Your profit and loss or income statements, referred to as both. It shows your revenues. It shows your net income, right? So it's going to show your gross, whatever your gross revenues are, you minus all of your debt, and it's going to show what you actually made, the company made. And that's where we come into, when we look at that. And if you show a negative net income, it's very hard to get a loan. So make sure that you're watching that. And honestly, it gives you a good trend of your business. And you can look at it and say, okay, wow, I'm spending way too much money in this area. So make sure you look at your profit and loss, frequently. Your aging accounts receivable report. This is, and not everyone's going to have this. So accountants, CPAs, anyone who does services and then bills is going to have this. So if you are a car mechanic and I walk in because I need new tires, I'm going to pay you right then. You're not going to put my tires on until I give you the money. But if you're a CPA and you're doing taxes, I'm going to send you all my taxes. You're already doing the work, and I'm not going to pay you. You're not going to invoice me until my taxes are done. So I'm basically fronting that operating cost. So your aging accounts receivable report basically shows who owes you what. Most banks, when you go, and we can use that as collateral, but it's not going to, banks typically will only use AR that is up to 60 days. So anything over that, 90 plus days, is not going to be considered an asset. So make sure if you do have an AR and you're collecting, that you're collecting within 60 days. So us bankers have a ton of, I call it lender jargon, right? So we have acronyms and we say all these things. And when I'm talking to somebody who's not a lender, they could have an PhD, but when I start in some psychology, but when I start talking lender stuff, they're like, I don't even know what that means. I didn't know what it meant. As Nancy said, I started this job as a receptionist, and I have a degree in public relations. So I had to learn all of this along the way. So I wanted just to kind of give you the basics of this. So loan to cost or loan to value. What do you need a loan for? So you guys that are on the call, like, what are you looking for? A line of credit? Are you looking to purchase real estate? It just depends, right? So your loan to value or your loan to cost is what the bank is not going to lend 100%. So you want to go buy a forklift. Typically, the bank is not going to finance 100% of that. The bank is not going to take 100% of your accounts receivable. We're going to do it within limits, so we know that you have some skin in the game, basically, and you've put your own equity into it as well. So if you're wanting to purchase your own office condo, typically on something like that, you're going to have to put 20% down. The commercial side doesn't have the like FHA loans where you can get less to put down. Typically 80% is the most. So it's basically the ratio of the loan to the value of an asset purchased. The collateral is, what are we securing the loan with? If you don't pay, what is the bank going to take to get our money back? That's the collateral. A lot of people, it can be real estate. It can be a lien on all business assets, which again is where your balance sheet comes in, because we're going to look at your assets from there. It could be a vehicle. There's a ton of different things it could be, but we need to know, what is the collateral going to be? The amortization, right? So this is how long. So if you bought a house, typically it's 100. I'm sorry, I'm looking at something else that says 100. 30 years of principal and interest payments for 30 years, right? And it's fully amortized over 30 years. In the commercial world, we don't typically do those longer loan terms. So the amortization period is, how long are your payments spread out over? Typically what you look at on a commercial loan is, and we'll get into this a little bit later, but like a real estate loan, we're not going to lend you, the max we're going to do is 10 years, but we can amortize it over 25 years. You don't usually see more than 25 years on an amortization schedule for commercial loans. So basically we'll spread your payments out over 25 years, but we're going to put you in the term for 10. And then when that comes due, you're going to owe the remaining 15 years. A balloon payment. So I just kind of briefly went over that. So that's when, it's 10 years, it balloons. So a lot of people get nervous when they hear a balloon payment. And I think a lot of it comes from when, through the recession, there was a lot of residential balloon payments. Commercial, it's just how it is. That's just how unless you can afford to fully amortize, you can afford the principal and interest payments fully amortized over 10 to 15 years on a piece of real estate, you're going to most likely have a balloon payment loan. So again, at the end of that term, whatever remaining amortization left is going to come due. Typically, you either pay it off or you refinance it. Working capital. So this is your assets minus your liabilities. It's how much cash you have left to operate your company. Debt service coverage ratio. This is one that I used to struggle with a lot when I started lending. And I'm like, I don't understand it. I couldn't find a way to easily explain it to somebody. But basically, it's the cash available to service the debt, all of your debt. So and this is the number one thing that most lenders look at. We want to know so if you hear your lender say that you need to be at a 1.25 debt service coverage ratio to qualify for this loan, a lot of people go to their debt to income ratio, right? So that's what they typically look at on the consumer side. Debt service coverage ratio takes into account all of your revenues and then takes out all of your expenses and then looks at what's left. And we want to know that you have more. So if I say you're at a one-time debt service coverage ratio, that means you have enough cash to make the payment, but nothing else. So I could underwrite your loan and you have enough cash to pay all of your existing debt and the new debt we're looking at, but that's it. There's no additional money coming in. So the bank looks for it to be at like 1.25 or 1.3. So the higher the debt service ratio, the easier it is to qualify for a loan. It's the cash available to service the debt. And the cash flow, all right, so this is the cash flow. It's simply the cash expected to generate by an investment asset or business. How much cash are you receiving? How much of it are you spending? So it's the difference between the two. Types of loans. In the commercial world, you have your SBA loans. So there's two types of SBA loans. There's your 7As So the SBA 7A is meant for startups, not just for startups, but it is a government guaranteed loan. So basically the difference between any of the SBA loans and the conventional loans that I'll talk about is that the SBA can use projections. So if you're a startup, which it looks like a lot of you guys are, an SBA loan is most likely where you're going to go. And so I'm going to get into all of these different types of loans here. The SBA 7A, so it requires less equity, where I would require 20% in, the SBA might only require 10. It allows for projection-based underwriting. So unlike conventional lending, I have to look at like historical trends. I need to see at least 2 years typically of your financials. I need to know that, maybe year one, you were not producing income because it was your first year and, totally, and trust me, if you are starting your business and in your first year you report a loss, it's okay. Most companies do. But on the conventional side, we're going to look at those trends. We want to see your company either growing. We really want to see your companies growing. You want to see your companies growing. But we will look at the history, where the 7A looks at projections. So you go and you're going to open a restaurant and you know that you have an existing restaurant and it generates this much income, but the new restaurant is in a better place and it's the same food and it's, you're projecting how much money you're going to make. SBA loans can be underwritten with projections. And some loans don't require collateral. Most of them do. And honestly, the SBA, I believe, if you own your house, will take a lien position on your primary residence. It doesn't matter if you already have a first mortgage, second mortgage. The SBA at some point, if you have a primary residence, typically put a lien on your house. Not all loans, but some of them. The 504 loan, this is another SBA. This is for real estate and equipment only. So if you want to buy a piece of real estate and you don't want to put the 20% down that I'm going to ask for, because on the conventional side, the SBA 504 is a great option. So it's basically split, and you can see it here. The bank takes 50%. So I'm going to take a first lien position on your property at 50% of the total loan amount. The SBA, so it says Certified Development Center, or Development Company. So the CDCs here in town, I think there's First Florida and Florida Business Development Corporation. They're the local CDCs in town, and they will take a second lien. They are kind of the liaison between the SBA and the bank. They will take a second lien at 40% of the total loan amount. So then you only have to put down 10%. So it's a great advantage, and you don't have to be a new business. This is for any business. I'm working on one now for a client who he just doesn't want to put 20% down. So we're looking at this option for him. Typically the SBA portion, the bank portion is going to be standard bank terms, conventional lending terms. The 40% is going to be SBA terms. So you're typically going to get a longer term, up to 25 years, I think, and a low rate, much lower than, I think the one right now I have is they're priced around 3%, maybe they were lower. That's the 504. So a term loan. What do you need your loan for, right? So you have to think about, what do I need the money for? Is it to purchase a fixed asset? Are you buying a vehicle? Are you buying a trailer for your lawn company? Are you buying computers? What is the need for the loan? A term loan is going to be a 5 to 10 year, depending on if it's not tied to real estate. Let's just say you want to go buy a truck for your lawn company. Typically, it's going to be 5 years, and it's a fixed asset. You're going to make principal and interest payments over that 5 years, and the loan will be paid off in the end. That's considered a term loan. So something that you make principal and interest, there's a term on it, and you make the principal and interest payments throughout the term of the loan. A line of credit. So this is where I educate most of my borrowers, because they call me and say they want a line of credit. And then when we talk about, why do you need a line of credit? And they'll say, oh, well, I need to do this, this, and this for my business. Well, they don't need a line of credit. They need a term loan. So you've got to know the difference between the two and what works for you for the purpose of borrowing the money. So a line of credit is for short-term working capital. Most of my clients that have lines of credit, I have a payroll company, or I'm sorry, a staffing company. So they staff businesses, large businesses. This company sends out $500,000 a week in payroll. They don't invoice their customer until after the payroll is sent. So they're basically putting their money out to send this payroll, then invoicing them 30 to 60 days, they're collecting on that. So they have a line of credit because if they fall short when they're sending, they pull from the line of credit until they collect on their AR, and then they pay it back down. If you're not going to pay the line down, then you need to consider a term loan. It's for seasonal. So if you're a seasonal company, let's just, we're getting into the holidays. If you're a bakery and it's wedding season and you're going through, making a ton of cakes and that's a busy time. And again, you're putting in all the operating cost up front. Maybe you collected 50% of the deposit of the total cost as a deposit. You're spending your money. So and then you're not going to get paid till the end. So the line of credit comes into play in situations like that. Short-term funding, and you have access to it quickly. It revolves like a credit card. So once you pay the principal down, and it's interest only. So it gives you that flexibility of only paying interest-only payments, and you pull the principal back and forth as needed. Typically, they're 1-year terms. So sometimes you see them some banks will do them longer than that. Most banks and credit unions, you'll see a 1-year term. And when you do the 1-year term, when it comes up for renewal, we're going to ask for updated financials. And then we're going to review how the line of credit operated over the last year. Did you pull it all out in the beginning and used it for permanent working capital and you've only been making interest-only payments? We're going to term it out and we're going to put it in a term loan. Did it rest at a zero balance? Is your company stable enough that you didn't have to depend on the line of credit the entire year? We want to know that for 30 consecutive days, you did not have to use the line of credit because your cash was sufficient to cover your operating expenses. So typically we look for that the line rested. Sorry, excuse me. The disadvantage to line of credit is that it's a variable rate. So typically it's tied to prime. The Wall Street Journal prime right now is 3.25. So you're going to have a margin there. So typically on like an unsecured, it's going to be prime +2, could be more. So prime rate, which is great right now because prime is low. I updated this slide yesterday, and I created this PowerPoint a couple years ago. And just to show you what prime used to be, when I updated the slide, I had my example in here said that prime was at 7.5. So prime a few years ago was at 5.5. It's down to 3.25 right now. Now that's all has to do with the economy and that. So that's a good rate right now, but you have to understand it's an adjustable rate. So if the prime rate goes up, your interest is going to go up. Oh, and also on the line of credit, most of them have what's called an on-demand or an optional renewal clause. So that basically says the bank can close it at any time. The bank can, if you're not operating it correctly, if they're asking for monthly reporting, the bank can close it. They can reduce it if you're not using it. There was a lot when the recession happened, back 2007 and 2008. A lot of banks closed. There were companies, very strong companies that had lines of credit, but they had nothing. They weren't using them. So the bank closed them or reduced, not specifically our bank, but just in general, banks reduced those limits on there or close them completely. Because from the bank's perspective, every loan I do, if I do $1 million loan, I have to take $1 million from the bank and put that in a reserve account. So the bank has to have a reserve account for as much loans outstanding that the bank has. So if I have $1 million line of credit that's not being used, and I've allocated $1 million in my reserve account, and this company's not using it, well, I can give that to somebody else who's going to pay me interest, right? So that's kind of the bank's perspective, a bank's perspective. So they can close it at any time. So just make sure if you get a line of credit, you're using it properly. Equipment loan, this is basic, right? Everyone's, I'm sure, bought a car before, same thing. We're going to take it as collateral. Typically, most banks don't do 100% financing. A lot of times I have customers come to me who want to buy equipment, and I refer them back to the equipment company who's giving them the equipment, because sometimes they have better terms. They can finance 100%. They may have a lower rate. So shop all of that. Look at all of your options for that. Then there's unconventional lending. So, and this is where I see a lot of small businesses get in trouble. And not everyone, and these are not bad loans, they're just unconventional, and they're not typically offered by banks. So we always say that these are loans that, until you're bankable, that these can be very beneficial for you. But I just caution you to, make sure you understand what you're getting into before you get into any of these unconventional lending. So factoring, basically, they buy your invoices. So if you're trying to think of a good example, if you're a pest control company and you go out and you do the service, then you invoice. If you have a loan through a factoring company, your clients are then going to pay the factoring company on your invoices. That's how they get their money back. So it can interrupt your cash flow, because you're invoicing it. You already took the money, right? So now you're using your invoices to pay back this loan. So it's not a bad loan. It's just unconventional. And if you do it right, it can work. Just make sure you're with a good company, a reputable company, and you have a good person helping you. Merchant cash advance loans, these scare me. And the reason these scare me is that I see customers that go out and they get these from their merchant. You accept credit cards as, I'm sorry, there was an announcement being made in my building. The merchant cash, so these clients go out and they accept credit cards, right? So you accept credit cards for payment from your customers. A merchant cash advance loan is, they take those payments. So basically they'll give you the loan, but then every day they will debit let's just say you submit for your credit card and for them to pay you. Once you submit that, let's say $1,000 is what you're owed from your clients. That's what you charged. That was the money you received. The merchant then comes in and takes 50% of that. So now you're down to $500, and it can be very expensive, and it really interrupts your cash flow completely. So it gives you access to cash quickly, but again, they're higher rates and interrupt your cash flow. And the cash flow, if I could say, if anybody takes anything away from this whole thing, I want you to understand cash flow. If you want a loan, you have to understand your cash flow. Here it is, the 5 C's. So it's cash flow. It's your ability to repay. How much cash do you have left over after all of your expenses? Character. The 5 C's are the things that the bank looks at when we go to underwrite a loan. Cash flow is, like I just said, very important. Character. What is the prior experience in your business? What is your character as a business owner? Were you a manager and then you were a manager at a car repair shop, and you were experienced, and now you want to go start out on your own? Well, your prior experience is your character. If you want to go open a restaurant and you don't know how to use an oven, and everything you cook, if you're like me, everything's in the microwave or the air fryer, I'm not going to go start a restaurant because I have no idea about the business. So that's the character. We want to understand who you are and what you do. And I will tell you, one thing I always tell my clients is, I can't lie about the numbers. The numbers are the numbers. The cash flow is what it is. And that's where your CPA comes into play, and making sure your CPA understands what your goals are. So the character, I paint the picture of my clients. Like, that's my job. I go out, I meet them, I interview them, I get to know them. I see their business. I see what they've done. You have to imagine, in 15 years that I've been at this bank and through 2 mergers, I have clients that I have banked. I have one in particular that I remember, he used to come in, he was on my overdraft report all the time because he was just, his cash flow, he could never get the money in fast enough. He was spending it faster than he could get it in. This client now, I think he's banked with me 12 years. He has $1 million in the bank. I have watched him grow, right? So that's super important. So I paint that picture. When he wanted a loan, I had to paint that picture of who he was. So character is huge. Credit is your ability to manage your prior affairs and financial matters. Your credit's your credit. You as a business owner are going to be responsible for the debt that your company takes out. So most commercial loans, any owner that's 25% or more owner in the company is going to be required to personally guarantee a loan. Now that's, I can say that's the policy here at my bank. It could be different at other banks or in credit unions. But we're going to look at your personal credit. So we talked about the debt service coverage ratio, right? So we're going to look at the direct, what's the company doing? How much is the company making? How much does the company have left over? But we are also going to look at what's called the global debt service coverage ratio, which includes all of the guarantors and possibly any other companies. If you own 2 businesses, we might throw in your other business to guarantee this loan if it's, stronger than, the company that wants the loan. So your credit as a business owner is very important. And I don't think business owners, they'll call me, they're like, oh, my business doesn't have a credit score. That's okay. Your credit, your business, it's hard. It's kind of, I think people assume that, oh, my business is doing great, but over here I'm not paying my bills and I've got, a 500 credit score. That's not going to work in the commercial world, because we are relying on you that if your company fails, you're going to personally pay back the money. So your personal credit means a lot. Doesn't mean it has to be perfect, especially if you have a great company that's cash flowing and maybe you just had a really bad year, whatever happened, maybe you just had a tough financial year and, if you're like me, your pool broke, your refrigerator broke, and everything happened in 1 week, and you just had to put out a ton of cash, right? So you put stuff on your credit card or whatever. If there's a story there, again, that goes back to character. But your personal credit means a lot. So make sure that as a business owner, you're focused on that in addition to your company. The capital, the ability to put money into the business. How much skin in the game do you have? That's what that means. Did you start your company from scratch and you took used all your savings? Hopefully not all of it, but did you use your savings? Did you save money to start this company? How much did you put into it? Would you as an individual loan money to somebody who can't help themselves, right? That might sound harsh, but that's kind of how it is, right? We want to know that you are as invested in your company. If we're going to invest in you and your company, we want to know you are just as much, if not more, invested and believing in your company. So we want to see how much capital have you put into the company. The collateral is the available personal assets and willingness to pledge them, right? So if you want to get a line of credit and you have no business assets, because that's just the nature of your business, you don't have any assets, right? You might have accounts receivables, but you don't really have any assets because you are that's an IT company. You work from home, you own your IT company, you work from home, you have a computer, maybe, whatever IT setup you have, but there's really no assets. There's no hard collateral. So you come to me for a loan, well, I don't have any assets I can take from the company. So I'm going to look at you personally and say, well, what can you pledge? Can you pledge your 401? Well, we can't pledge 401k, but do you have stocks you can pledge? Can you pledge your house? Can I put a second lien, a second mortgage on your house? Is there equity to do that? So that's what we're looking at. I'm going to stop. Does anyone have any questions? I know I've been talking a lot.
No questions in the question box, but folks, please go ahead and ask your questions in the question box, and we'll make sure they get answered.
Thanks, Nancy. What the bank wants to know. So this is when you walk in to apply for a business loan, the bank wants to know, and this isn't everything, this is just kind of general. How much money have you or will you be investing into your company? So that goes back to the capital that we just talked about. How much money do you still need? Okay, so you started your company and you've used your own cash to buy the food truck and get the equipment for the food truck, but now, or you bought the food truck, but now you need to buy the equipment, right? So what did you put into it and how much is left, and how much more money do you need to make your company successful and to get going? How long will you need the money for? Is it temporary working capital or is it permanent working capital? Again, this goes back to the difference between a term loan and a line of credit. We need to understand what the use of the money is. Where is it going? How will the funds be utilized? What are you going to use it for? Are you going to take the money and purchase a piece of equipment? Or are you going to take the money and set it in your checking account because you need it for operating expenses? What are you going to do with the money? What is your ability to repay? When and how long? This goes back to the cash flow. How much can you afford in a payment that won't overextend you as a business? So that's important to remember. You don't want to get into a loan where you're like, oh, I can afford $500 a month for whatever, whatever the loan is that you need. Don't overextend yourself. Understand how much you can afford in a loan payment and for how long. If you want it for 5 years because you need a lower payment, do it for 5 years. Just remember, if you're doing something like equipment, you don't want to do a term loan that's longer than the useful life of your equipment, right? So you buy a computer and it's going to only last you 3 years. That's a really terrible example, but you buy a computer, it's only going to last 3 years. You don't want to go get a 10-year loan on it. So understand the value of what you're using the money for, and understand your ability to repay. That's what the bank wants to know. How much can you afford, and when are you going to pay us back, and how long is it going to take? What will you do if you don't get the loan or the company fails? What's going to happen? That goes back to the personal guarantee on loans. You as a business owner have to be responsible for the company, and what happens if you don't get the loan? Are you still going to be able to run your company? Loans are meant to help small businesses, right? Like what we do is to help the small businesses in our community grow, not just grow, but to start to grow. But what if you don't get the loan? Are you not going to be able to grow your company? So always have another strategy. The loan is a great option, but also remember, you're paying us interest. We've all had loans, right? We all owned a house, bought a car. If you get a loan, you're paying for it, right? So, and if your company fails, the bank wants to understand, okay, great example, right? So COVID hits. Who in a million years would have thought, well, I don't think anyone ever thought COVID would ever happen, but the hospitality industry, right? We have these giant hotels that they can't make their loan payment because nobody's staying in them. In the peak of the recession or in the peak of COVID, they're not staying in them, and nobody's going to hotels. Who would have ever thought that hotels would just be empty? So what was for the bank's perspective, what's going to happen next? You don't have people coming to your restaurant. You don't have people coming to your hotel. How are you going to make that payment? So you need to know that and be ready to tell the bank that. So this is what you need to know. I just kind of went through, what is the loan? How does it work? What we look for. This is, and I'm going to pull up, 1 second, a personal financial statement. I don't know if any of you guys have ever had to fill out a personal financial statement, but I can tell you it is the most tedious sometimes, and it can be a very overwhelming feeling when you get this and you're like, oh my God, that's so much information. What do I do with this? I'm gonna pull one up. I'm gonna pull up a sample of what we use. But this basically just paints the picture of who you are as a company. Okay, can you guys see that? Nancy, can you see that?
Yes.
Okay.
There you go.
All right, perfect. So this is a personal financial statement. So it's going to go over like who you are, right? Your name, social, all of the details we need to know. Then it's going to get into your assets. This is your balance sheet on your personal income, your personal financials. So you have your balance sheet for your company that we talked about. This is basically your balance sheet for you individually. This does not include your business. Okay, so here it says value of closely held business. This is going to be the value. If you were to go sell your company, how much would you get? What is it worth? So this is not, I have my business checking account has $30,000 in it. That's not going to go in this. This is what is in your personal account. And I could do a whole nother webinar on personal income or personal bank accounts and business bank accounts and what not to do and how to keep your money separate, and don't use your business checking account as a personal checking account, but that's a whole different webinar. So this is your assets and your liabilities, and then it comes up with your net worth. This is how much you're worth. You can, I mean, if you were interested to go and look at this, and if you, before you apply for a loan, every bank is going to ask for this for a small business loan. Some are a little bit more detailed than others. Ours is pretty basic. So you're going to, put in your assets. This is all of your assets. These are your liabilities, and we're going to come up with your net worth. We're going to talk about your income. How much money do you make? If you're a business owner and you don't pay yourself a salary, this is going to be your salary is your gross. This is going to be your W-2 income, basically. If you don't pay yourself and you just take distributions, which is fine, and a lot of companies do that, that's going to go here. But it has to be reflective of something. You have to prove it. So that's where small business owners, I think, run into some where it gets a little gray area. You don't pay yourself because you're investing your money back into your company. But how are you living? How are you buying groceries? How are you paying your car payment? That has to be, we have to prove that. So if you are not paying yourself a salary, or even a minimum salary, 25 grand a year, whatever, on a W-2, talk to your accountant, talk to your CPA, find out what makes the most sense for you. If you think you're going to get a business loan in the next couple of years, next year, whatever, we are going to look at your personal income. And if you are not paying yourself anything, and on your personal tax return you report no money, it's not going to work. So that's why it's so important. And people do that. And so again, we as bankers and lenders, we understand why small business owners do the things they do. But when it comes to credit and it comes to underwriting, numbers are numbers. So just remember that. So this is going to go through your income information. And then this is just general information. The second page of this is, okay, this up here is a snapshot. This was a snapshot of what you look like financially. The second page is the detail. So you said you had $10,000 in cash. Okay, what bank is it at? What type of account is it? Is it in your name? Is it a joint account? And what is the balance? So this is where you're going to get into the detail of what you did on that snapshot. If you have debt, this is going to be your more. Actually, there's a different place for real estate. Let's say you have a line of credit or a personal line of credit. Again, this is all personal. This is not your business debt. So you're going to list all that out, your accounts, life insurance. If you have life insurance, this base amount policy and cash surrender, these are two different things. If you don't have a cash surrender value, this is zero. Cash surrender value means that if you default on your loan and you've pledged your life insurance as collateral, cash surrender means how much can the bank get? This is gonna be your stocks and bonds, and then your real estate. So this is where you could put, if you're a small business owner, but you own your house, but you also own 3 rental properties. You have invested and you own these 3 properties. So you can list those here, if those are held in an LLC for liability purposes, and it's just you and there's no partners, you could essentially list those here. So that's a brief. It can be overwhelming, but this is a personal financial statement. Super important. That's what we look at. That is your financial picture. Other things we're going to look at. So on the conventional side, we're going to look at, like I said before, we look at the historical data. We look at the trends of your company. So we're going to require a minimum of 2 years personal tax returns. And this is going to be, again, for anyone 25% or more ownership. Again, that's my bank's policy. It could be different at another institution. So just make sure you understand that. Typically, that's the requirement. It's pretty standard. So we're going to ask for 2 years. We're going to look at 2 years of business tax returns. So if you don't have 2 years business tax returns, because a lot of you guys are new companies, if you don't have 2 years, it's going to be hard for you to walk into a bank and get a $100,000 line of credit or whatever. You're going to probably need to go to the SBA, unless it's cash secured because somebody, either you know, have cash that from, you know, you sold your house or whatever you did to get the money, you know, or you borrowed against your, or took it out of your 401k. The only, most likely as a startup company to get a conventional loan is only if it's cash secured. Now, I'm not saying that, I can say you can probably get a small one. Some banks have, I know that we have a credit driven loan, small business loan. So we don't collect financials. We still want the company to have been in business for 2 years. But if not, there is a credit driven. So the guarantor must have a 700 or better credit score, but that only goes up to 25,000. So you can, not saying, I don't want to discourage you guys and think that you're, just because you're a startup, you're not going to get a loan. You can, you just need to shop and understand. So we would typically, though, require 2 years of business tax returns. We're going to look at your interim financials. So, you know, we're in October now. Oh gosh, we're almost in November. We're going to look at your year-to-date P&L and balance sheet. We want to know what last year. So let's just say you started your company in 2019 and pretend COVID's not a thing. 2019, you reported a loss because it was your first year and you had all these startup costs, and you reported a loss. Then 2020, business picked up and you were doing great and you reported a little bit of income, which is great. And then now you're in year 3 and we're in November. We want to see, what are the trends of your company? Are you continuing? Are you growing? Are you staying the same? What is your annualized profit looking like? So we will look at your interim financials. So again, goes back to having your balance sheet and your P&L and having the soft like QuickBooks or your accountant, making sure that stuff is always updated. And then a debt schedule for the company. So most business loans don't report on your personal credit. So we're going to pull your personal credit and look at your personal debt. But we don't have, business loans don't get reported the way a consumer loan gets reported on a credit report. So we're going to ask for, what's the debt? Does the company have, you know, if you're a pest control company and you own 3 trucks and but you have monthly payments all in them, you know, so we want to see the debt and what your monthly payments are for that. On the SBA side, they're going to want most of all of that I just talked about, but they're also going to want a lot more. They want a business plan. They want to know, you know, the details about what you're doing, your overall plan, the description of your business, what makes you, the marketing. How are you going to market your company and make it successful? They're going to want, again, similar financials. They want now they will require 3 years tax returns on no matter the loan size. Typically on the conventional side, it's a minimum of 2. I know policy at my bank is if the loan's over 500,000, we're going to ask for 3 years. So it just depends. Again, every bank is different. These are the financials they're going to ask for. They're going to also ask for your resume. They want to see what's your experience. This goes back to the character when we talked about the 5 C's. Sources and uses. So the sources and uses is the breakdown of your project cost. So you want $1 million loan, that's the source. The uses is, okay, I'm going to use $500,000 to purchase the land, and I'm going to use $500,000 to construct the building. That's super basic, but that's what that means. Finding a banker, right? So I say finding a bank, and then I put because it's super important. Again, I go back to, you need a good attorney, a good CPA, and a good bank or banker. You have to find what works for you and your company. I can say, as part of SBRN that Nancy mentioned in the beginning, there's a ton of us bankers in there, and it's amazing because we refer business back and forth to each other, because what fits my bank might not fit another bank, and vice versa. So I pulled these numbers yesterday. So there's 52 FDIC banks in Jacksonville. This is just Jacksonville, Duval County. This doesn't include St. John's, Clay, or any of our surrounding areas. There's 52 banks, and not locations, but different banks. And there's 14 credit unions. You have options. You need to focus on building a relationship. Again, I told you about my client who, I remember him being on the overdraft report, and now he's got $1 million in the bank and $1 million line of credit. You have to find a bank that's going to grow with you, and you have to understand where you are right now. If you're a startup, a credit union might be a good place for you to start. A bank may not be the right fit for you if you want a loan. Credit unions and banks are chartered differently. They're under different regulations. There's a lot of differences. Again, a whole different webinar I could do on that, but you have to find what works for you. relationship is important. Again, I paint the picture of who my client is, and because the numbers are the numbers. It is awful changing banks, and we get that. It's a tedious process. But if your bank's not working for you and you don't have a relationship banker, you don't have somebody that you can call, you don't have an email address, you're waiting on hold on a 1-800 number, and you want to grow your company and you want to get a loan and you need somebody to kind of guide you along with that, even though it's hard, you might need to change. These are just things to consider. What do you love about your bank? What do you hate about it? Do you want to know your banker? Look, I'm the most outgoing person. I love my customers. Like, I stop by and bring them donuts. I see them at the grocery store and we talk for 10 minutes. Like, I am an involved relationship manager. If you don't want me to run into you at the grocery store because whatever, you're just not that person, you're an introvert and you don't ever want to talk to anybody, then maybe, again, something to consider. Maybe you need an online bank. Maybe you need a big bank that, you can do everything online. Here at this bank, we're $23 billion bank, but we're a community bank. That's our culture. So decide what works for you. These are some resources that I've put out here. So the SBA is a great resource for startups and small businesses. Obviously, the Small Business Development Center, you guys already know about that. The FDIC, NCUA, and these are just some, if you want to go research banks, you can go, this is for banks and this is for credit unions. So FDIC is banks and NCUA is credit unions. And then SunBiz, obviously, I'm sure if you guys are all registered business owners, that's where you register with the state. And I have 2 minutes to spare. I think I did all right.
Yeah, you did great.
I never stay on task, so
well, those of you attending, if you have questions, please put them in the question section. Aaron, one of the things that we run into frequently, especially in startups, they're afraid to take out a loan, and so they get their business started and they use their own money to get going, and then they hit a cash crunch 6 months or a year into it, and correct me if I'm wrong here, but it's difficult to get a loan for working capital versus a loan for, say, equipment or real estate where you've got some collateral. And am I right on that?
You are right on that. Yeah. So the working capital, again, it goes back to, we want to know how much you've invested in the company. We want to know what you personally, how much you believe in your company and how it's going to succeed. An equipment loan, we have hard collateral. You don't pay it, we're going to take it. But trust me, the bank does not want your collateral. So I have a lot of customers that come in and they're like, you can have my house and you can have these investment properties and you can take all this collateral, but they don't cash flow. I don't want their collateral. It becomes more expensive for the bank if I have to go and take the collateral, the bank already now has, it's more expensive. The bank does not want to take your collateral. The working capital loans are harder to get because we have to know they're we call it blue sky, right? The SBA calls a lot of what they do blue sky. They're lending on business assets that aren't really there and don't really have a tangible value to them. So yeah, it's important to use your money. It's important to show how invested you are, but you also don't want to over leverage yourself. So that's super important.
Yeah. Aaron, thank you. It looks like we don't have any questions, so I want to thank you for presenting today. Great information. And those of you in the audience, if you would like more information, Aaron's got her phone number and her email address there, and she'll be happy to help you. And I will say that, and I would encourage you, if you have not met with an SBDC consultant, that's what we do, is we help prepare you so that when you go to visit Aaron or another lender, that you've got all your ducks in a row. You've got your financial projections, especially with startups, because you don't have a track record. I mean, you have a personal track record, and how you handle your personal finances is obviously a key element. But we can help you with those projections. So short there plug for the SBDC. And let me remind you that at the end of this webinar, you will receive an evaluation, a request for an evaluation, and a link to the recording. so that you can go back and review the information. It was a lot of good stuff. So Erin, thank you again. I wish you all a happy Friday, a happy Halloween, and come back and see us next time when we'll be doing our webinars. So have a great day, everybody.